Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
April 2nd, morning everyone. Research meeting.
Morning.
We'll just be going over the usual stuff just on the market. A lot of stuff going on, obviously. And yeah, we'll just start off with my report this week, a little change to the order. Just a quick disclaimer at the front end, no securities advice this week, no tax advice. Same thing for our US-based listeners and clients. Just contact us through our email or our websites to talk to one of our staff members. Quickly looking here, just looking at the S&P 500 this week. It did actually bottom, it seems like, for now. We'll have to wait and see. With a $3 increase week over week and an overall $5 reversal. It did create this short-term support at the end of last week. Obviously, the Iran instability, a big question. Last night's Trump address really got investors a little optimistic yesterday, I'll say. And then this morning, the price of oil, I think, spiked up by about 4 or 5%. I don't have it in front of me, but we'll have to see, obviously, how the futures market fades into the rest of the day. I think the futures market was down by about 1.5 points when I was on the subway this morning at about 8. And I think the price of oil was up about 9 or so percent. So we'll have to see. But nonetheless, looking here, still remains below the 3 major moving averages that we track. Momentum on a weekly and monthly basis, negative. Overbought, oversold, heavily oversold still, but an increase week over week and heavily oversold 5 weeks in a row. You can see on a trailing 12 months and a forward basis, P ratio coming back, obviously, as just getting a bit of a compression, especially on the trailing 12 month, especially as the market pulls back. So we'll have to see, obviously, if that continues or we get a reversal more in line with market performance, less in line so far right now with earnings. Looking here at NASDAQ, kind of a similar move, $3 increase, a $5 reversal off of the bottom, bounced off support. It could obviously pull back more close to that line at 23,000 if we get a bit of a pullback over the next few days. Just with the way action's going this morning. We are on the longest negative weekly momentum streak since last spring and approaching a period back in 2022. Just one more week and we'd surpass the negative streak that we saw in the spring of 2025 during Liberation Day. Overbought, oversold, highest since March 6th, but it's the 9th straight week it's been oversold. Best sectors in the NASDAQ continue to be energy, defensive, and semis, except for NVIDIA. The rest of NVIDIA and the AI hyperscalers and the Mag 7 are all down pretty massively year to date, really being led by Microsoft, which I think is down about 24%. So following those very closely. Looking at obviously the PE ratio, we've seen a bit of a pullback, kind of a similar trend with the S&P 500, but still pretty heavily elevated. Looking here at the Dow, chart looks the best actually this week. Had a nice reversal with a buy signal, so bit of a trend break there. You can see only a few boxes from breaking this trend for the first time in about a month and a half. But it is still trading below its 50, 150, and 200-day moving averages. In terms of momentum, mostly negative. Overbought, oversold, negative for the 5th straight week. The price objective did reverse for the first time in 2 months. So it does have a bullish target now, which would be close to an all-time high on this chart. The all-time high on this chart is 50,500. You can see the price objective there. But nonetheless, technicals, I'd say warming up a little for the Dow, but it is only a week of this strength, so we'll have to see if there is some sustained strength. Looking here at the TSX, 6-box reversal this week, a new buy signal. That's the first since February. It is up year to date despite the weakness in the markets. Energy obviously driving that. It is the only North American indice that's up year to date, one of the only major global indices that's up year to date, obviously off the backs of a lot of that energy exposure. But you can see here the chart doesn't point to as much weakness as the U.S. Indice charts. There are a number of lines of support. You can see here created support a couple weeks ago, and that was support that it had previously used back in December. Created some short-term support this week. From a valuation standpoint, much more attractive. Overbought, oversold, still overbought this week, which is a really positive sign, especially with the recent market action on the technical side. So really watching that there and really happy with the way the TSX continues to perform. Looking here at the VIX, new sell signal. Starting to see a bit of a breakdown here, but it is only a week, and I would assume with the way the market action's moving this morning, the VIX is probably going to pop up a little today. The target does remain bullish, which points to a higher VIX, but this continued upward trend, it's still following this trend line despite this decrease in the VIX. We have seen a couple decreases in recent months, but that weakness hasn't sustained and broken this trend. So we could continue to see this. Obviously, you can see the trend line here, still a ways away from breaking that trend line. And if it does reverse today, it could spill higher, or excuse me, it could point higher for the VIX. Looking at these technical indicators, I'll go through these pretty quickly. Not a lot of changes. S&P 500 almost in bearish territory here, dropping by 2% for the bullish percentage chart. NYSE a little more elevated at 40%. And then looking at here, the percentage positive trend, you can see the Dow and the NASDAQ 100 here, a bit of a spread there. And that kind of correlates with what I was saying. The Dow does look a lot more attractive right now from a technical standpoint on a relative basis. I'm not saying on an absolute basis, just on a relative basis. And that coincides with a lot of the technical indicators pointing to a little more positive momentum for the Dow relative to more of those growth-weighted indices. Looking here, Toronto Stock Exchange, no changes this week. No changes really over the last few weeks, so we'll just skip over that this week. Looking here, asset class rankings, not a lot of changes in buy signals this week. The big change happened last week when we saw a big gain in international equities and domestic equities, and a big decrease in commodities driven by everything except for energy. But the biggest movers this week were energy again in the commodity space. Energy in the sector space picked up a handful of buy signals. Tech lost a handful, and then utilities had some strength. Like I keep saying, a bit of that rotation towards value names. And I know obviously there's the exposure when you're in utilities to interest rates, but there does seem to be somewhat of a rotation into more defensive names right now. And investors obviously rotating some capital, especially with the risk factors in today's market. This is just a quick chart on the S&P 500's return by year of the presidential term. So you can see the election year, year one, the midterm year, and year three. Obviously, the outlier midterm year. You can see going back to 1962, the average return for the S&P 500 has been negative 1% in those calendar years. Only 50% of those years have produced positive returns. When you compare that to year three, year one, and year four of a presidency, the return differential is pretty substantial, and the percentage of years that are positive is also pretty substantial. So we could be in for a bit of a flat to negative year if history repeats. Obviously, nothing's absolute, but you can see also for year three of the presidency, that year coming out of the midterms, a lot less uncertainty, a lot more gridlock in Washington, I'll say, because oftentimes there's a bit of a correction in the president's policy, and you get a split House or you get a split legislator. So we'll have to see. And I think right now it's forecasted that the Democrats are going to take the House. I'm not too sure about the Senate projections, but they'll be able to obviously keep the president in more of a lockstep, we'll say. Um, when you're looking here on a chart basis, kind of the same thing. You can see the gray line, which is the midterm year, compared to the other 3 years going back to 1960. But even this year's sell-off to start the year, historically, that sell-off doesn't come all the way until October, right before the election, and you get an improvement in the market, which obviously happened in 2022, the last midterm. 2018 was a little different with that sell-off at the end of the year, but we'll have to see obviously what happens closing into the election time. Looking here, this is gold. Price target just reversed up to 5,300. It was negative for a while. I just wanted to mention that even with the pullback we've seen, kind of bounced off some short-term bottoms, we'll say, and perhaps a period for investors to scoop up some gold exposure who were underexposed. The last 4 weeks saw some of the largest outflows in gold ETFs ever. You can see on the chart on the bottom, which is a chart from Bloomberg and the ICE benchmark, which tracks all of the fund flows in the United States, Europe, Asia, globally, where they're seeing outflows, inflows, obviously. But we saw these massive sell-offs in the last 4 weeks, and I think that's a bit of an overreaction, perhaps. A great time for investors to add some exposure. Why? We like it for the stability. We like it for the inflation protection. So do global central banks who are rotating away from treasuries. You can see here, this is a chart from Bank of America Global Research, which tracks foreign treasury holdings and world gold holdings in reserves. Gold just peaked up above treasuries for the first time in decades. You can see gold now accounts for about 24% of this chart's total reserves. The U.S. Treasury about 21%. About a decade ago, that number was 33%. So quite a 10-year period change. What else do we like in the gold precious metal space? Mining stocks, according to this chart from Tavi Costa at Azura Capital, could be breaking out after this correction. Obviously, markets always have correction. Indices always have corrections. It's healthy. Stocks don't always go straight up. Perhaps this period where we saw a major pullback in the precious metal space, especially in the mining area, was a period for some investors to add some exposure. The valuations remained highly attractive. Precious metal prices with where they are right now, margins are very strong for these companies. And I think it's just looking through the short-term volatility. These massive moves that you see in the mining space are short-lived. Obviously, it's a highly volatile sector, but just not overreacting to some negative price movement in the short term. And I think that's really helped us in the last few weeks. And then a couple more charts, just looking here at India. This is INDA. We have exposure to India through a different instrument. It's been one of the worst performing indices over the last year. One of the only major ones that is down year over year. It's down about 13% year to date. Its valuation has compressed completely down to 19 times forward earnings. Back last year, there was just because of some elevated valuations in many of its large cap names, some question marks about valuation. But I think right now with the pullback in that, the government continuing to spend, foreign direct investment continuing to pour into India, and economic growth continuing to remain strong, I think perhaps a time for investors to rotate some capital away from other emerging markets, but also maybe away from more expensive markets like the USA, and into some high growth areas that are basically down over the last 2 years. and trading at pretty attractive multiples where growth remains very robust and I'll say just much more attractive from a policy standpoint than the likes of China. Looking here, this is Go Easy. This is just a chart from FactSet. Obviously had their earnings this week. Joe was talking about it a lot. I'm not sure if he's touching on it, so I won't get too deep into it, but obviously earnings were below their consensus. They had a large write down on one of their assets that they had purchased in the last few years, reported weaker guidance than expected. And then the big kicker was their charge-offs are expected to come in much higher throughout this year than when they announced them just a few weeks ago. I think it was close to 1.5 times higher in terms of their charge-off guidance for 2026. Now, what has that done? Obviously, last month the stock's down 65%. Last year, about 75%. But then when you go all the way back to its IPO years ago, it has erased so much of its gains. It's now lagging the S&P TSX composite, according to FactSet. And even over the 10-year period, it's doing the same thing. So once one of the strongest performers in the TSX just basically erased most of its gains within a couple month period. And then this is just a piece that I actually saw online. I think it's AI that created this, but just a little piece there. And I think with all that, I can pass it over to Joe if you've joined the call.
Great, thanks, Ken. Yeah, sorry for taking time to get in. Had some swirling issues with the internet here. No, I won't have anything on Go Easy. I think that's enough. Let me share my screen. Yeah. So just an update on Georgian Partners. They were in the news this past weekend regarding a sale. A sale of an investment. So let's get into it. We'll do a quick charts of the week. I think Ken covered off the main points. Of course, the disclaimer per usual. So Georgian's been one of our Canadian VCs for years. They sold a 4.5% passive equity stake in the company to Navigator Global Asset Management this past weekend. It was $100 million, designated for an equity slice and some sprucing up of stuff at the company, but mainly monies are going to be allocated for future Georgian partner funds. Very importantly, none of the company's founders, are getting any payments out of this 100 million. And the main sort of go forward thing with Georgian Partners is this in-house AI lab, which they have. It's approximately 20 people, really, really sharp people, kind of PhD level, and even more than that in some cases. So it's really impressive. But the problem is some of their legacy portfolio companies, of which we, unfortunately have a few, have sort of become caught in this, issue where they're kind of like the bags that are getting heavier, so to speak. And the rest of this update, so the rest of my comments are just relating to the quarterly update from Georgian Partners Growth Fund 2 itself. The only story that's kind of going to be noteworthy is the Armis sale. There's a pretty big transaction with Armis, which is one of their same cybersecurity companies. We don't have it in Fund 2, and the kind of underperformance of the Fund 2 companies has resulted in the multiple kind of dipping lower to that 1.4 times area, and unrealized value down by over 20%. We've gotten back about half of our money or committed capital from Georgian. They're still really kind of firstly and mostly a software company, but they I think realized that they kind of I think AI really just sort of exploded and caught some of these SaaS businesses looking the other way, and you see it in share prices of stuff like Microsoft and Constellation. They've kind of moderated a bit, but Constellation got rocked. I mean, that stock went straight up for as long as any of us can remember. And kind of from an industry perspective, the funding for global SaaS businesses was higher by 50% last year, and that's certainly nothing to sneeze at. You're also seeing uh, companies kind of stepping up on the valuation side, so that's good. I think the one thing I'll kind of say is the vibe out there seems to be, rather than build it yourself, just buy it out if you can find an AI capable company right away. So let's get into the Fund 2 portfolio companies. This is Top Hat, and it's in that applied analytics space. So mainly focusing on, academia and government. And, there's a bit of an issue here in the sense that they met revenues for Q3 25. They missed EBITDA slightly, but, their problem's going to be, spending by these university, and AI labs, right? So like I went to U of T, and, there's a little lab. Well, there's a couple of labs at most university. I'm talking about specifically these AI labs. And, the universities are, I guess they had been spending a lot on this because academia is usually, 10 years ahead of industry in terms of kind of research and that sort of thing. So there's some issues here in the sense that, they're going to have to really get either the government or other schools to start investing. So that's kind of Top Hat. FreshBooks is essentially a small, it's basically accounting software. And with them, they almost hit their plan for revenues in the quarter. They did beat on EBITDA, and they did sign a deal with a company called Kick to expand its bookkeeping services in the United States, which is good. That should be a growth area. And with a lot of these administrative bookkeeping and sort of accounting things, the more you can automate, the less stressful your life will be. Alita is a company that's based in Vancouver, and again, this is part of the applied analytics space. It's sales and marketing, which unfortunately is kind of getting tagged here. There's issues with regards to the revenue miss as well as the EBITDA miss in the quarter. Their biggest challenge is just really the whole idea that a lot of these digital marketing firms are having their customers say, I'm spending a pile of money on digital marketing, and I'm not, necessarily getting as much back as I thought I would. So there is sort of a, return on investment issue kind of percolating through these companies. And the other problem is that with these established, marketing agencies, they're kind of at the threat of AI and other things that are like essentially faster and cheaper. So we'll see how it goes. East Tire, they missed on revenues and EBITDA. They're a cybersecurity company, which has sort of been the last man standing in this software kind of as a service room. It's usually a pretty good place to be. But you're starting to see some pricing pressures. So, they've had to do a lot of free trials, and, someone signs up and they're like, well, okay, it sounds interesting. We think we're going to go with you, but, can you give us 90 days free? And, can we try before we buy type of thing? And that unfortunately does eat into, your margins. As they're based in Cambridge. CEO Bailey got shown the door, and Jim Foster took over after the quarter ended. So, we'll see if Jim has any bright ideas. Telium met revenue targets for the quarter. They missed on EBITDA, and they're again in that sort of sales and marketing space, which once again is sort of under some pressures. There is a deal that they did with Snowflake. Looks like it should put out around $3 million worth of potential opportunities. And again, those are potential opportunities. This is not, revenue that they've booked. and looks like the chief of their product division took off. So not maybe the best story there either. So that's Telium, and then finishing off with Bluecore. They kind of, you name it, and they missed on it, and so the issue for them was churn, predominantly in their communicate business. Again, another sales and marketing company. So, if you're thinking I sound like a broken record, it's that's the way it is. Sales, marketing have been kind of slowing down. I mean, cybersecurity, I think, is more mixed. There's definitely some winners there. And then anything in sort of AI is really a function of the overall, AI spend. And if governments and universities and industry are cutting back, then, they're cutting back. In fact, right now, I think the best job in town is to be an electrician for, one of these data centers. Those guys are making all the money. So we'll see how that goes. Over to charts of the week. I'll go through this really quickly, because I think Ken nailed a lot of the key points here. But, it was all about quarter end and sort of Trump's comments on the war. Let's take a look at the charts here. So his risk on risk off indicator, came back over the green line just based on the last maybe 48 hours of trading, which is, it's something to look at. The S&P almost got through that first lower standard deviation, the oversold standard deviation of the 50-day. So it's made up some. It's healed a little bit from some of the technical damage that you've seen, across most of March, frankly, which is, it's better, but it still has a little bit of a ways to go. And you can see in this slide here, multiple support zones down below. Looks like that, second one down from the first broader green one kicked in and did its job. There was also some other trend line moving higher there. But that kind of upside down smile, aka a frown, still kind of indicates the market is in a bit of a downtrend, I think. And there's now this overhead band of resistance there at around 6,800. Looks like it. So we'll have to see how we contend with that. And so he kind of zooms in a little bit more closely on the big cap index here, and you still got this downtrend, which is intact. So not really sure what the advice there is. Not that we provide any here, but I guess if you're looking for an entry point, either be careful or sit tight. This is just another look at this. We looked at this chart last week. This is the percentage of stocks on the NYSE above their 50-day, and really you want to be for sure above that lower green line and towards that dotted black line. At least it's not going lower, I guess, is the message from this slide. Oil, that's all anybody's been talking about for the last couple of weeks, justifiably so. And so you can see here in the top panel, I believe that's WTI. Yeah, I think that's WTI. So maybe probably better to take a look at Brent, but I think they're more or less the same. The real idea here is that, when you look at stocks and bonds and even some of the metals, everything now is like, how is it priced as a function of oil? And so this inverse correlation where oil goes up and everything else, goes down, or vice versa. That's what everyone's kind of trying to, figure out. And Andrew said last week, as well as the week before, that if you're contemplating an oil investment, now is maybe not the best time to make that investment. Certainly in the commodity itself, the companies I wouldn't know as much about, but until this pattern kind of shakes itself out, Andrew thinks it continues. And then the last one for me is just this comparison of the S&P 500. This is kind of a funny comparison because it's essentially comparing U.S. equities to global equities. And the all country world with the letter X is essentially the all country world without the United States, or the S&P 500 in it. More or less is that's the composition of that index. So he's trying to compare and contrast the performance of U.S. stocks to everything else. And for a while, it was almost a no contest. It was U.S. equities all the way, and potentially that's kind of unwinding a little bit. But after yesterday and kind of the finish of the quarter, maybe that kind of changes. Who knows? The one thing I'll say is some economically, I get the stocks are traded where they're traded and that kind of thing, but the top, let's call it, pick your number, 15% of the S&P 500. These are big companies. Like they're doing stuff all over the place. So it's a little bit, funny to just kind of label them as American. Like, sure, they're American, but look at these guys have subsidiaries everywhere. So it's all kind of a tangled up web. That's it for myself. I'll pass it back, Ken. Thanks.
Awesome. Thanks, Joe. Not too
You
sure.
bet.
Sean Cumby, are you still on here? Do you want to share your slides this week?
All right, so I was away last week. Surprisingly, it doesn't seem like much has changed. So let's rip through the macro. The returns are terrible. Still holding a lot of crypto, and crypto just isn't working. I was short NASDAQ futures yesterday. That's worked out this morning. I've covered those. I have a put on, a put spread on. And currently, I just entered a short trade in oil this morning. That's just a very short-term trade. Big picture is essentially the same. We're looking towards midterm elections. It's not going that great for Trump. Oil is priced for war. This move this morning looks like somebody has capitulated and had to buy in West Texas. Normally you see Brent trade at a premium to West Texas, and that's reversed. We've got WTI, $3 over Brent right now, as far as I can see. We're up about 12%. What's quiet in the background is the yen carry trade is still, in my opinion, unwinding and putting pressure on things. As Ken noted, the move into gold is a huge strategic move between Russia, Iran, and China. There's like this currency war about the petrodollar going on. That's I don't know what we're going to call it, the oil dollar war or something, but it's playing out with bombs in Iran right now. Investment themes, they really haven't changed, except the crush that's coming now for the global economy is the distillate supply is being severely impacted. Deliveries of all kinds of distillates that are used for industrial processes are choked up because of the Strait of Hormuz. Asset classes, I flip back to year to date and just see this dramatic increase in oil. And shockingly, not a lot of movement other than the disaster in crypto. Got gold up 10%. We have the S&P basically flat. S&P flat or down a bit when the US dollar is up a bit. That's a temporary thing. We're in a flight to quality mode right now. Economics is pretty much the same, but I will note that growth, which at one point was 5.4% by the Atlanta Fed, primarily, it turns out, delivered gold, really boosted returns. And that goes again to this point where central banks around the world are hoarding gold. Recession, not now, but the risks are definitely rising, especially with this distillate constraint. That is going to be backlogged for, could be a month, 2, 3, and then everything downstream, jet fuel, plastics, even medicines, cosmetics, everything gets backed up on that. The US dollar, kind of going a bit more sideways today. The war is clearly priced in. They definitely want a lower dollar long term, though, so watch for that. Gold, the thing that took it out was twofold, right? We had a parabolic rise that was driven by retail. We had the margins reset, led to a massive drop. And then we've seen it kind of bounce around from the low of the massive drop. I expect that the bull run will continue. Silver, same thing. If anything, the demand for silver will probably accelerate as more and more countries are going to say, like, I need alternative sources of energy, and solar seems to be the way to go. China's, in 100 million ounce a year deficit for their solar production. They need silver. I expect that demand just to continue and continue and continue. Oil, it's war. Like, I don't know what else to say right now. I see the futures are, 113.20. That's a dramatic move up of 13% in a day. That's got squeeze all over it. Whether it goes back to 100, I don't know. But the world doesn't work right now with oil up here. Rates and credit, shockingly unchanged. We've got the same Fed funds, the 2s, 10s, up 1 basis points. The mortgage rates are just up a couple, and high yield, I think, is only out 8 basis points, which is shocking. Just see more and more problems coming in private credit. The overall U.S. equity market, definitely weaker. We've got a couple charts to look at. We're in extreme fear. It's not at zero, but it might as well be. But I will say this: when we've had extreme fear before, if we get any form of a resolution, we have the potential to bounce back. I still see this buy the dips mentality going on. Microsoft missed on earnings. Apple is just keep to whiffing on their AI Siri implementation. Hopefully they get that straightened out. I think that can be a big catalyst for the market. The big news this past week was some employee at Anthropic accidentally exposed the entire code base of one of their fantastic products called Claude Code. Someone grabbed it. It's now been converted from JavaScript to Python, Python to Rust, and apparently anyone can copy it now off of GitHub, and it's not copyright infringement, which is quite bizarre. And that is really one leg of 3 legs that support the valuation of Claude Code. All of their competitors can now copy it. They have some unbelievably powerful functions built in that they haven't released yet. This is, again, going to be a wild, wild AI ride. Now think about that. Some employee exposed a code base, and there are these guys that have bots that troll these code bases and all of these repositories to look for changes, openings. And when it was spotted, it went on to GitHub and accumulated more what are called stars or references or likes than any other project ever as quickly. Like, it just blew up. 50,000 stars, I think, in like a day or two. This means that if just the defined weights for the neural networks that run these large language models are exposed and grabbed, they can be run on any computer using like LM Studio. That's the basis for a big part of the valuation of those companies. A single set of weights. That's staggering. That's like somebody being able to Control C, Control V, 50% of the value of your corporation. That's kind of scary to me. It's not the whole reason for a high valuation. The whole reason is also your ability to improve and increase and expand what you're doing. But it is quite something when you can get a powerful large language model and its application through Claude Code basically in a Control C, Control V moment. Something to think about. S&P, my indicators are danger. We've seen this The heat map, which is 8 indicators from 3 days out to 60 days, turn red. We're looking at the moving averages rolling over. We're seeing an inverted VIX curve, which is never a good sign. And we're seeing narrowing breadth. This is just not good for a nice, broad, healthy market that can advance at, 8 to 20% a year. Is it a top? You never want to call tops because it's always in the rearview mirror, but this sure looks like a top to me, right? We've seen the regression fit flatten out. It's now negative. We see a big lid in terms of volume right at that 7,000 mark on the S&P E-mini futures, and then we're seeing the heat map, the trend map, red. We're seeing the pressure factor, which is a market cap weighted RSI, kind of in the middle. That's why I'm happy with put options right here. And we're seeing the breadth, splotches of red. It's not the nice broad market that we had from December and February. That kind of said like the rest of the market, the 497 names were catching up to the Mag 7, and now that's fading. Crypto's broken. Is it in a basing pattern? I really hope so, but 60 to 70 is where it's stuck. Downside could be 45K into the fall. Sentiment is terrible. The use cases are not improving, despite I think it was Stripe rolling out and block to tens of thousands of businesses. I just don't see the use case for crypto that once was. It's just not happening. The Clarity Act is not done yet. Supposedly coming, but it's been coming and coming and coming. We'll see. So Bitcoin breakout, no. Technicals are just terrible. There's no narrative right now to really support this. It's not being played as the digital alternative to gold in this current market. And our cartoon for today is based on Trump's speech last night. Sir, your speech was amazing, perhaps the best speech ever made. And it pulled at 100%. We asked everyone in the room.
Yeah. Jeez.
Do I want to go next? Is there anyone else here? Chris, are you on the call, Chris?
Yep, I'm here. Gilbert, yep. Happy to go ahead with some quick comments. Like Sean mentioned, Sean eloquently set out, the markets are pretty troubled, and that certainly applies to the rates market. Fixed income has not had a good month in March. Long bond was down about 3% in the U.S. In terms of outlook for rates in the U.S., there's really nothing on the horizon. No, according to Reuters, there's no cuts, no hikes. A lot of commentary could be entering into a range of stagflation. Powell made a very interesting speech at Harvard on Tuesday where, he thought that the Fed funds rate was in a good place. And, a lot of people took that to mean, no hikes. And, certainly at the beginning of the year, we were talking about Warsh coming in as a governor, and, we're going to see a couple of hikes on the back of his arrival. But, that's all gone from the market. Stagflation is certainly the topic that people are talking about. I did want to mention the Canadian dollar. I don't know if, people have been looking at that, but it's been absolutely pasted. Like it's down about, it's down from almost 74 cents to 70, the high 71 cent level. And, I think that's, it's over 2 cents. It's almost a straight move down, which is good if you're holding U.S. assets, which I think you guys do. Tomorrow on the holiday, we've got U.S. non-farm payrolls. The prior month, this would be for March. Prior month was 92,000 jobs were lost. The estimates are for a gain of 60,000, but these numbers are subject to a lot of revisions. So it's really the revisions are as important as the headline number. And I'll pass it back to Gilbert, and I wish everyone a happy long weekend.
Okay, thanks, Chris. think what I'll do is I'll just quickly share my screen and go over a short report. And I don't think there's anyone else on the call after this, right? So should be quick. Okay, hopefully everyone can see my screen here. Short report, and here's our disclaimer. S&P 500, once again, I know we did have a sharp sort of rally in this week, but I continue to look at this long 200 week exponential moving average as the base potential for an actual bottom. And I know that's quite a long way from here, but there's a lot happening right now which could suggest that this would be an ultimate bottom. And I'm going to take a look at some technical indicators that do suggest that at this time. Again, taking a closer look, the similarities between where we are now and what happened in 2025 are I think they're clear to be seen. And the speech last night from Trump, where he said that they're going to hit, I think he said that they're going to hit harder in the next 2 weeks. That's a little concerning, especially given where we are here technically, that anything could sort of trigger further downside for the market. CAPE ratio, once again, rolling over, similar to what we saw in previous rollovers. I think the question now is really where are we going to find a bottom? When we take a look at credit spreads, once again, we're coming off of this low level, and the question here is where do we really find a wideness between spreads that will suggest that the market has kind of bottomed, because we see this correlation here. One thing I want to point out is longer term. This is my main concern. Joe's talked about the wedge pattern before in technical analysis, and when you take a look at the wedge that's been building since 2008, this is a pretty strong one, and we could see a release like we saw, prior to this. And so the concern is always there, obviously, given all the factors. Defense versus growth, again, we're, a little bit of a gyration here, but we're not seeing any material rotation back into growth here, still favoring defense here. Market breadth. Yes, we've had a nice little bounce here off of this low around 20% here, which is what, sort of this green zone that we've been talking about for some time. But this is related only to stocks trading above the 50-day moving average. When we take a look at stocks trading at the 200-day moving average, what we can see is that we're not in the green zone, which, in the past has marked a bottom, and has marked a bottom with the S&P 500 chart that I showed before. And that's one of the reasons why I'm a little bit more concerned about downside from here, not just from a technical perspective, but from a market breadth perspective. Longer term, this is a chart that I've shown before. This is from Apollo Research, and it shows S&P 500 forward PE ratio versus subsequent 10-year annualized return. And once you get into this low to mid 20s forward PE ratio, returns turn negative. And so that's where we are. This was as of December 25th, and December 2025, excuse me. And since that time, we've seen the market roll over. The question is, how much more is this going to occur? How much further does the market have to go? But from a long-term perspective, again, we're looking at 10-year annualized returns here. Everyone's talking about oil. This is a chart from FactSet, CNBC, and you can see that oil spikes typically coincide with recessions. And what we've seen here is, I don't think anyone's going to argue this is an oil spike. And when you have higher prices of oil, it just puts a strain on the global economy. It puts a strain on everybody. And I was actually shocked because I hadn't been tracking oil day to day. But yeah, Sean was right. It's up at 113 as of this morning, which is pushing the high from the war announcement level. So, oil continues to rise. Longer term, again, I'm going to not necessarily pound the table about this, but I want to bring this to everyone's attention that U.S. unemployment continues to show a downward trend. Chris pointed out that we are going to get the non-farm payroll tomorrow, I believe. ADP numbers, which came out earlier this week, were positive, albeit modest. And again, when we take a longer term look at this, when non-farm payroll starts to top out and roll over, that's when we see recessions. Same thing here with the year over year non-farm payroll. We're starting to see it's been positive since the reopening in COVID, and now we're at a negative level. We're approaching it. Real personal income, which is the second main recession indicator that the NBER uses, again, has been coming down since the post 2023 high after the 2022 low, and every time it's gone negative, we've seen recessions. And so if you are concerned about any of these potential threats to the market, please reach out to us. We do have a solution with our partners at Universa. So that's it for me. Anybody else have anything to say today?
Not here.
Okay, well, if you're watching this on YouTube, thanks for watching. Remember to like and subscribe, and yeah, we'll be back next week with another episode, and yeah, have a happy Easter long weekend.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks, and visit mcnichollasset.com to learn more.